Welcome back, guys, to another episode of Mitchell Group Media. Many people want to buy a home, but they just don't know where to start. So let's get to it. If you're not a homeowner or just never thought about buying a home, this is definitely for you. If you have thought about buying a home, I'm speaking to you directly. But first, like and subscribe, and you can circle back to this video as needed because it's a lot of information. And who wants to subject themselves to this much torture at one time, no matter how necessary and important it may be for your financial future? So grab a beer or two, and let's get started. Homeownership should be everyone's focus if you don't already own one, for a multitude of reasons. First of all, there's the obvious reason for building equity, and you do this in a couple different ways. Through appreciation in value and by paying your mortgage down. Everything in between is equity. There are tax benefits associated with homeownership through mortgage interest and tax deductions. It helps strengthen your credit history, and for me, the most important thing is offering the stability of not wondering if your landlord is going to extend the next lease, and if they do, how much more will increase, or worse yet, having to find a new place not knowing where that's going to be, and doing all of that with a family is an added stress you can work to eliminate. It's also worth mentioning that you always pay a mortgage, but when you rent, it's just someone else's. There are different types of residential real estate, which we will address. While many of the same concepts will remain the same, no matter what state you live in, I have a broker's license in the state of Florida, so I can only represent the scope of my knowledge to this state. Purchasing real estate can be a daunting task and quite confusing, but I'm going to help you overcome that. In today's market, purchasing real estate is much like going to a coffee shop for the first time saying, "I want a coffee." It's just not that simple. Knowing where to begin can be the most difficult part. There are many factors to take into consideration, but every decision ultimately comes down to knowing yourself and what's right for you. Your first primary residence will almost never be your last, so think about what's right for you now. And a good rule of thumb as far as length of time is going to be what's right for you now to the next 5 years. This doesn't mean if you're not going to be in the spot within the next 5 years, then don't purchase real estate. That's not what I'm saying. Sometimes in as little as 2 years in one spot can be a great investment and a store of value. What I mean by a store of value is the increased equity in as little as 2 years can allow you to sell and at least get your investment back. This can effectively allow you to live rent-free for the time you're in the property. I'm giving generalized guidelines from my own personal experience and the experience of others to make you confident enough to consult with a local professional in your market when you're ready to do so. If you're located in Florida and you feel you're ready to buy, reach out to me and I'll put you in contact with a local professional I would trust to do business with in your market. They will be able to tailor to your specific needs. Now let's get down to it. You're going to need money. There's just no way around it. Sacrifices and commitments will also have to be made. I know what you're saying, Einstein. That's why I haven't bought anything, because I don't have any money. But do you know exactly how much money you need to satisfy your initial real estate purchase? Do you know the type of mortgage that you would qualify for, or what will work best for you? Do you know how much money you would need to put down based on the average cost of housing for the particular type of real estate in the particular market that you would like to live in? If you don't have those figures in your head, that's what we're going to work on getting. This is going to be a bit of a process. It's nothing that you're going to devise from one video, and there's going to be a learning curve, but I will walk you through the entire process. There are programs that people may qualify for as a first-time homebuyer, depending on your location and financial situation. There are types of mortgages that are available for people with low credit score, and some with as little as 2% down. Be sure and check out my video on mortgages. That might be a 3-beer video, but in the meantime, to give you an idea of what affordability looks like for you, I'll give you some figures to help you get the process started. Lenders require a total monthly housing expense ratio that does not exceed a certain percentage of your total monthly gross income. Some borrowers can go as high as 31%. So what does this look like? If you're making $100,000 a year, your monthly income would be $8,333 before taxes. Roughly. Using the monthly housing expense total, divide that by your monthly income and multiply it by 100 to find your housing expense ratio, which is $2,608.53. This would be an example of the max payment you would be allowed based on $100,000 a year, 31% of your gross income. So you're saying, okay, great. So how much house can I afford with that? We're not quite there yet. Underwriters also take into consideration total monthly obligations ratio or debt to income ratio. This includes the payment that you make each month on auto loans, student loans, credit card debt. Anything that requires you to make monthly payments called revolving debt is considered part of your monthly obligations, secured or unsecured. To understand the difference between types of debt, be sure and check out my video on what is debt and how can it be good. Some borrowers may qualify as high as 36%. It's very important to understand lending institutions take into consideration the amount of potential debt you may incur if you have credit cards, especially the ones with high limits, even if you don't owe anything on those cards. You see, credit is viewed as possible debt, so it's important to take into consideration, and one strategy for qualifying may be eliminating not only credit card debt, but the cards themselves, or at least the ones with high limits. You can also request on the cards with a more favorable rate that your limit be lowered for this purpose. This is where a lot of people get confused and why a lot of people do not qualify, because based on the figures above, this only leaves you room for $391.47 worth of revolving debt after your penny payment or your principal, interest, tax, and insurance payment of $2,608.53. It's also important to add that if you don't put down 20% on your property, you'll have to pay mortgage insurance of some type. This will eat up more than half of that, and there's still a possibility of homeowners association dues. Now comes the credit score. Your lender will pull your 3 credit reports, one from each of the national credit bureaus of Experian, Equifax, and TransUnion. These reports will also list outstanding loans and credit card balances. You will need a minimum of around 620 to qualify for a mortgage, but the best rates will come from scores of 740 or higher. And if more than one person is on the same loan, the mortgage company will use the lowest score for offering the rate because the chain is only as strong as the weakest link. So based on the figures above, you can roughly qualify for a $340,000 home with $15,000 down. And this is a solo single income figure. When you have a partner or a spouse that can contribute to that, then the number will change, obviously. The payments will change depending on the rate as well. The higher the interest rate, the lower the qualifying amount. This is a very basic figure. But once you have a figure, then you have a goal to work towards. If you do not have a figure, you do not have a goal. And if you don't have a goal, then you will never reach it. Once again, I'm going to generalize. Ideally, you want to live as close as possible to where you work or go to school. Yes, you can do both. In fact, I encourage you to always continue in some type of education to advance your commercial talents. Investors will always tell you to diversify your investments, and you'll hear often that your biggest investment is your home. But your biggest investment isn't going to be in your home. Your biggest investment is going to be in yourself. So I suggest you use the same philosophy. You want to limit any type of commute as much as possible, no matter how far it is, to reach what's affordable for you. I know people that live above where they work. I know people that have to drive 2 hours one way just to get to work. The idea is to keep that distance as small as possible to reach your goal. Sometimes people work and live in the market that's affordable for all types of real estate. A house, a townhome, a duplex, a condo, or an apartment. Sometimes what's right for you is a matter of convenience over price. Sometimes it's a matter of price over convenience. And keep in mind, with every stage in life, it may change. Know yourself, your wants, your needs, and most importantly, your why. The last one is very important. Know your why. That's going to be the secret between being happy with your purchase and the best overall fit. Ever heard of buyer's remorse? Well, it's a real thing. It's like postpartum for purchasing a home. But at the end of the day, no matter what it is that you purchase for whatever reason, it's almost always going to be a solid investment. And it will always be better than renting from a financial standpoint, so you can always find comfort in that. When you hear people talk about how renting is better than buying, you need to understand their possible perspective. The only reason this would be true for anyone is if they are investors and consistently earn more from the market with their free capital than their real estate market can generate. Even from a financial perspective, sometimes peace of mind is worth that. And most people can't generate more capital than the real estate market can consistently. And there's still the constant threat of not being in control of how long you may live in a rental. In case you're wondering by now why I want you to buy a home, very simple. 3 main reasons. Number 1, when you purchase a property, it strengthens the economy from the inside out. Stability in your life means more stability in the economy. And over time, more disposable income and more income for you means more commerce for the economy. Number 2, when you purchase a single-family home, that's one less home that a corporation gets to purchase for their rent-only platforms, keeping you renting and paying their mortgages indefinitely, and driving the housing market even higher with no home ownership involved in those living in those properties, which means less overall commerce for the community. It makes it more difficult for these types of communities to grow, but that's definitely another video. And number 3, the more homes get purchased, the more homes get sold. It keeps the industry cycle going, which happens to be my industry. It also increases property values at a healthy rate, as homes for rent never sell, so they never contribute to an increase in local value increases. Only properties that sell do that. Let's address the most common types of residential property in a very specific order. Usually the order that people purchase property: an apartment, a condo, a townhome, a duplex, and a single-family home or house. This may be the general order of property price from high to low, but not always. Each type of residential real estate is different. Each has its pros and cons, so I'll address the basic differences in these types of residential real estate so you can better understand what may be best for you, and you can pursue more details on these particular types of property in my video, What Type of Home is Right for Me. Let's start off with an apartment, which if owned is likely to be a co-op, but it doesn't have to be. Furthermore, duplexes and townhomes can also be a co-op, which is probably the least common type of all property in real estate. A cooperative association is a nonprofit corporation that buys and owns a multi-unit building. Shares of stock in the corporation are sold to individuals who in turn are given a proprietary lease by the corporation, allowing the shareholder to occupy a specified space within the building, or the unit. But you do not actually own the unit. Through Florida Statute 719, shareholders enjoy the same benefits of ownership as any other owner in real estate, such as with taxes and mortgage interest, equity buildup through reduction of mortgage debt and appreciation value, but you do not actually own the unit, so you do not receive a title, which can make for a very complicated lending process when available at all, as most are all cash purchases. That leads us to a condo. What exactly is a condo? A condominium is a privately owned individual unit in a community of other units with fees, restrictive covenants, and conditions imposed by the homeowners association managed by a board of administration. The fees associated with this type of association are for common area maintenance due to fractional ownership of the common areas that can at times include special assessments. These special assessments can be on top of your HOA association dues. Condos offer a combination of shared costs with lower utility bills, making a condo easy and sometimes more affordable for first-time homebuyers. They don't have the upkeep and maintenance of a single-family home, which can make a condo the easiest to own. A condo offers community life with shared spaces and events, as well as an added element of security. Now, what is a townhouse or townhome? This is a type of house with multiple floors and at least one shared wall between the units, and most often part of a homeowners association or HOA. Townhomes are typically more affordable, making it a good option for first-time homebuyers as well. Townhomes and row housing can sometimes be the same thing, such as with brownstones, but most often townhomes are not part of row housing, which are typically more urban, whereas townhomes are usually more suburban. Just another one of those confusing elements. So what is a duplex? A duplex is similar to a townhome in that you will have more than one unit separated by a wall, but a duplex is specifically created for two households, whereas a townhome may have multiple housing style units next to each other. A duplex doesn't have to be side by side. A duplex can be one structure with an upstairs unit and a downstairs unit. Much like a townhome, the owner of a duplex would own the structure and the land that it sits on. While it's not impossible to own and sell half of a duplex, it's very unusual and impossible without a strata title. But one obvious benefit of owning a duplex is the potential for renting out the other half. Now, single-family homes are just that. One home on a piece of property, usually not attached to any other home. While there may be different types and styles of single-family homes, the concept and legal definitions will usually remain the same. When you purchase a single-family home, you will own both the structure as well as the property that it sits on. Now, with that being said, can you legally advertise a townhome as a single-family home? Well, legally, sometimes the answer is yes, because you're owning the structure and you're owning the ground by which it sits, which is the government's definition. But it's very uncommon for a townhome to be advertised as such. It's a bit misleading, and no one really has time for misleading advertising on either side. But just so you know, I'm sure there's somebody out there in some market saying, oh no, a townhome is also a single-family home. I told you, it can be a bit confusing. There may be misconceptions on pricing that certain types of real estate are cheaper than others, but that's not always the case. It depends on location, size, and the age of any property in question. Now that you're starting to understand the concepts of location and the different types of properties, now you can start thinking about what would be the best fit for you. Also, now that you have an idea of the money and financial conditions that you would need to have to get the ball rolling, start educating yourself on other aspects of homeownership. My other videos will put you in the driver's seat and make you feel much more confident in the process. This is the whole point of Mitchell Group Media, to provide you with transparency and the necessary information needed in real estate to further your financial position and start thinking about your finances in a more responsible and informed manner. Once again, if you found any of this information informative, please like, subscribe, and ring the bell so it may help someone else. Thank you very much, and be sure to check out these videos.